During the Great Recession period in 2008, according to Case-Shiller, a single-family home median price peaked in 2006 at roughly $184,000. By 2012, this same median price had declined to roughly $134,000. This 5.5-year period represented a staggering 28% devaluation in real property value. Using this same median price average, we saw the peak rise to $308,000 in June of 2022, a whopping 130% rise. By all accounts, and as we are starting to see from the current erosion, this rise hasn't been sustainable. According to Case-Shiller, as of November of 2022, single-family home prices had dropped 3.2% in 4 months. This data, however, has a lag period of 3 months as indicated by their own definition of calculation, and others, like Redfin charts, have indicated that some areas have experienced a much greater drop in median home prices than the Case-Shiller index presently represents. So taking a deeper dive into regions, many areas are experiencing a much greater velocity of devaluation. 5 areas in particular show 3 times the pace of reduction, including Las Vegas, Boise, Seattle, Phoenix, and Austin. Using Redfin charts and comparing the 5 cities, the peak single-family median price for sale occurred in May of 2022. In Las Vegas, the peak at May of 2022 was roughly $455,000, and as of January of 2023, it dropped to $392,000. This $63,000 drop was actually a 14% drop in home sold value. Boise experienced a peak of $593,000 and a drop to $490,000, a 17% drop. Seattle shows a peak of $885,000 to a drop around $723,000, an 18% drop. Phoenix experienced a high of $509,000 as of May of 2022 to a drop of $437,000 as of January of 2023, a 14% drop. And finally, tech-heavy Austin shows a peak of single-family median pricing of $657,000 to a reduced $497,000, equating to a staggering 24% drop in the median home sales price. As I mentioned in my prior video, this velocity of acceleration is at minimum 20% greater than the prior 2008 to 2012 era, which was labeled the Great Recession. Although factors affecting both eras are different, there are many similarities as well, and history has a way of repeating itself, and as the Old Testament proverb states, as a dog returns to his vomit, so does a fool return to his folly. One distinct similarity is the correlation of the prior era's implosion relative to the subprime market and this current devaluation affected by institutional investment over normal mom-and-pop homebuyers. But before we get into that, be sure and always like and subscribe if you find this helpful. As you can see by the chart, subprime mortgages only represented 20% of the total mortgage market, yet it all but destroyed the financial mortgage market and moved the country into the greatest recession since the Great Depression. Leading up to the peak of median home values in 2022, institutional investors dominated the sales process, capturing 18% of all homes sold. It is now evident that Wall Street bet wrong. Numerous public companies, including Opendoor, Zillow, Redfin, and OfferPad, swooped in and determined to change the way home purchases were made, becoming the buyer and supposedly shortening the lengthy sales process. This caused areas like Phoenix to experience an explosive yet fragile rise in property values literally overnight. The Case-Shiller single-family home median value chart shows this 130% rise in property values during this period. But the law of physics once again settled in, and what comes up must come down, as we are now experiencing. The similarity of the two eras is the subprime days flooded the market with properties that banks were forced to foreclose because homebuyers couldn't make their payments with the former lax lending standards. This time, it could be that these public companies are now dumping their product on the market at prices significantly lower than the original purchase price because their predictive model was frankly wrong. According to a recent article in Bloomberg, companies like Open Door lost money on 89% of the homes it sold in the fourth quarter of 2022, or roughly $58,000 apiece prior to accounting for fees and expenses. In just the past 2 years, Open Door's stock price has plummeted 94%, and others are following suit. Redfin is down 92%, Zillow 80%, and OfferPad is on life support, having lost 96%. If during the meltdown of the 2008 era, subprime mortgages only totaled 20% of the total mortgages originated, yet it took down the remaining 80% of the market, could institutional investors that dominated the landscape of home purchasing and superinflating home purchases cause the same serious damage to the housing market, or even greater, by being forced to liquidate their portfolios and creating a velocity of devaluation greater than that of the Great Recession? Institutional default could yet be our black swan event that triggers the next era of decline.